Is there someone? Okay, wait. I'm just trying to put YouTube on my iPad and we can chat. I wanted to do hello. I wanted to do a video, but it's not. I recorded myself and then I just thought, let's go live and answer questions. Wait, so can I see here? Maybe not. Ah, I can. Okay. Interesting. So like this should be better. How are you, Misha? There is some delay between what I say and so I guess I should just go. I'll try to bring more people. Can you hear me well? So I was doing. Wait, I'm going to try to bring more people. One second. One second. How can I make an invite link? There must be something here. It's my first time doing this. Not organized. I just share the link for the YouTube. Is there a link here? Maybe I can get it here. Here. Okay. Yeah, so, okay, let's chat. On not a lot, I guess, for 3, 2. Okay, so if you don't have questions, I just chat alone, I guess. Right, can I see here? Then you have. Yeah, so, okay, you want to talk about the app? I was going to talk more about the markets and stuff like this, but we can talk about the app. The app, I think, I mean, maybe because I'm I'm used to it, so for me it's not too hard. But the idea is pretty simple. You receive signals. I mean, there are different stages. If you're just new, I don't know what you're doing. You get the signal with what are the stocks of interest to buy, how much you should allocate. So whether it's risky or not, you should allocate more or less. It tells you how long you should hold. It gives you an indication of when to sell, basically. But then you don't. Then there are a lot of small things around it, like when you sell, if the stock is doing well and if it fits well into your portfolio, you're not just going to sell on a specific date. You can hold and slowly cost average out. So slowly you sell as you need cash, basically. It's always like for cash management. So that's the main idea when you start. But then when you can take it a bit at the next level, where you don't just look at the signal, but you try to understand what is short and like to build your portfolio. So you will have some long-term stocks that you will stick to, kind of. You buy and you hold them, knowing that these ones are supposed to grow faster than others, and you will try to take smaller positions that are more risky on other stocks. I'm just saying it live, it's not prepared. But basically, things like earnings, things like momentum trades, like RGTI, it's a bit of a momentum trade. Like you see there is rising interest, everyone is jumping in, but you understand that it's overvalued. So you're not going to stick to RGTI for like 10 years, I mean, you can do it like this, but you're not buying with a 2 years mindset. You're buying with a 1 month or 10 years mindset. And when you see do times 20, well, you should start selling slowly. You're not going to say, it's times 20, I'm going to hold it 10 years. I mean, obviously it's overvalued, So like when you buy options, you cannot force yourself to sell, because I mean, me, when I bought RGTI, I put 3 weeks. I thought, okay, either it goes to 0 in 3 weeks, or it does times 10 something, and that's it, I'm out. Like I'm not sticking for 1 year, Anyways, so that's a bit the thing. So yeah, in the end, you build your portfolio. You have like some long term, some short term. Ideally, you're like in between, and you manage your risk. So like long term, you can go bigger, and the things that are risky, you don't want just to avoid them. You want to buy a bit, but like keep it small. And okay, so that's a bit about the app, but let's talk about something else. It's the thing I was thinking about earlier when I was doing my small workout. I was just thinking, like 2 months ago, everyone was talking about recession fear. So like recession was everywhere, like, oh, recession. We need rate cuts. So we need rate cuts because basically what is recession is a slower economic growth, everything gets slower. With rate cuts, you make cash more available. So you give essentially money for free because money becomes less expensive. The yields go down, so it's cheaper to grow. You give money for free. So when you give money, it stimulates spendings because people get cash, they can spend it, and it stimulates revenues for companies, and it stimulates the economy. And so it was everywhere, like recession. We're afraid. We need rate cuts. Now, okay, so there has been at some point this dip, and then markets keep going up, because rate cuts, it helps. And then mid-December, we heard, no more recession, essentially. Maybe inflation will be high, so no more rate cuts. And then boom, same thing, fear, no rate cuts. You see a dip because no rate cuts. So like no more. We're not stimulating the economy. Cash is going to stay expensive. Trump is coming. Trump wants high yields. So cash would be expensive anyways. And now the fear is switching to no rate cuts. Yeah. But what really happens is that you have more inflation now. So the economy is growing better than expected. And I don't know if you see where I'm heading, but basically there is always something to complain about. But in the end, the overall trend is positive, like, okay, there is no rate cuts, but we don't do rate cuts. There is no rate cuts because there was too much employment. Employment much higher than expected. So what we see is economy better, etc. So if you have more employment, it means people have more money. Same idea, it's not free, but the money is here. And if they have more money, same thing, they spend more, they will spend more, So revenues will be higher for companies. And it's the same thing. So revenues will be higher, and the same thing as rate cuts. In the end, the final impact is the same. It means economic growth, but no more recession. So it was recession, now it's inflation, But like in the end, it's all good for stocks and for the long run, because even inflation, what is inflation? It means people will spend more, prices go up, but revenues go up, So cash is not less expensive, but the final impact is the same. It's revenues up for companies, and the revenues up means stocks going up. I know this is important because, of course, we're trying to pick stocks and things like this, and not to focus on the. But in the end, everything correlates with the market. When you buy a stock, okay, maybe one would do +10 over the other one, but if the market is down -50, everything goes down. If the market is up plus ×2, everything is up. So there is a feeling. There is a sentiment that builds just from what the overall market trend is. And then you have like the stock picking and things like that. And okay, let me check what you asked. Okay, I just keep chatting. And so yeah, I thought it was funny because like recession, now it's inflation. There is always something to complain about. Now we see there is like some more momentum. Why? Because there was so last week we had the job employment report. Now we had CPI, and CPI is an indicator of its consumer price index. It tells you about inflation, basically, what level is inflation at, and CPI was in line with expectations, so it means like everything is correct. So the goal of the Fed is to stabilize prices. Basically, they want to make sure that everything runs smoothly. So if there is if the economy is slowing down, they will do rate cuts to stimulate it, so it keeps going up. But then, if it's going well, they will do less rate cuts because they don't want to do something like this. They want it to remain like this. But so in the short term, we will see this a bit down, and then it comes back up, and it moves like that. And so in the past, there was no intervention. There was no rate cuts, whatever. There was no buying bonds for cheap. There was no quantitative easing. All these interventions, they didn't exist. And so what happened in the past? In the past, as soon as there was a crisis, the stock would do this, like -70, -90. If you look 50 years ago, a crisis was -90%. Today, you don't see that anymore. Today, you see -25%. It's like the end of the world. Like we lost 25% on the S&P. It means some stocks did -50, like done. But before, it was not like that. Before, it was like proper sharp crisis. And over time, what we see is thanks to all the knowledge we build about the economy, thanks to just like now we can send rockets to Mars. I don't know, like same thing. The economy was smarter about it. So like we use interest rate cuts, we use all kind of monetary policies. I say they to make sure that everything runs smoothly. And so yeah, there was a dip. Okay, but it's not the end of the world. There was no proper crisis. There is no point getting scared every time there is a small dip, because what you can do. So if you want to hedge yourself or feel more confident about it, like at the end of this month there is the Fed meeting. So what you can do is buy the VIX, for instance, before. Why? Because when you buy the VIX, so before the meeting, people don't know what happens. And you have all this news. Oh, inflation, recession, whatever. Okay, I like it because it rhymes. And So right before there will be a short-term dip. And this creates volatility already. So like already when you have a dip, the VIX is the implied vol of S&P options. What does it mean? It means that it goes up when there are uncertainties and fear. When fear is high, the VIX will be higher. It can also go up when there is strong confidence, sharp confidence, but usually it doesn't happen like this. Usually confidence is slow and the fear is sharp. So like the dips are sharp. And so what you can do ahead of these events is buy the VIX. Okay, so it gives you a small hedge if it goes wrong. The VIX last time, mid-December, it took plus 40% in one day. So imagine you get a call on something as soon as the news is released. The news is released during the day, So it's not like you don't have a weekend to process it. It's like released. The guys, they trade right away. And what they do, they all put the talk on the TV screen on the floor. They look and they analyze the words, like they analyze the sentiment. And as soon as they get a negative or something, boom, they trade. And you have no liquidity. So like it's like the middle of the day when no one cares anymore, and boom, it affects the price. So yeah, so it will hit. The VIX can go crazy on those days. If nothing happens, you're fine. Doesn't matter. But if something happens, okay, maybe there will be a sharp dip and you lose on the stocks. But then you bought something that does plus 40%. If you buy calls on it, your call goes I don't know, like times 5, times 10, depending on the maturity you pick and the leverage you get and your strike. But it gives you a hedge. So yeah, if you're scared of these kind of events, if you want to trade on them, what you can do is buy the VIX ahead. So there's a dip, and then during, either you sell right before or you want to go through the process, and you need to look at what they say. And it's a training also. Like it's an art to look at the speech every time, listen to Powell, sees what he says every time. It's an art, and you can watch it on YouTube. Huh? There is a link on YouTube. I'm talking alone. Okay, I'm checking. There is not much comments, but yeah, you can check the links on YouTube. I can share them even in the app or here. Anyways, I'll post it on LinkedIn or whatever. And they stream it live, so you can yourself check it live and see how the market reacts. And it's a nice training because you see how it reacts based on what they say, So like, of course, the first time you don't understand, the first 3-4 times, whatever. But after a while, yeah, you get a feel and you can react fast, actually. But then it's all short term, like I said. So like the guys, they trade it short term. There is market overaction because it happens during the day when there's no liquidity. No one is processing the news. By the time you see minus 3%, minus 4%, I mean, most people, they get scared. So like, and then it creates a real effect, like there is then sentiment. Then it affects sentiment, and maybe the dip can go on for 2 days, and the next week no one cares anymore, and boom, it rallies. Well, like right now we see a small rally, but again, no rate cuts doesn't mean it's bad. It just means they are trying to make sure it goes up at a regular pace. Okay, now let's talk about what stocks to buy and stuff like this. Okay, so like now, and we see it on the market. So every time Trump becomes president, he likes high yields. Like he likes high yields. Why? Because with high yields, basically he likes the financial sector. Okay, so like he's a rich guy. He likes to create volatility on the market. Volatility are good for funds. He likes to increase yields, and you see the US dollar getting stronger. And every time, so like the US dollar right now is almost at, we're going to see the dollar stronger than the euro soon. And I like to have some dollars, some euros, some pounds. So I don't like try to trade Forex. I just put a bit everywhere. And even when you look at your stock portfolio, if you are in the US, okay, the value matters. If you're outside of the US, there is a bit more upside just from the dollar being stronger. So like if I sell my stocks now and convert to euro or to anything, it will be worth more than it used to. And why am I saying that? Oh yeah, so the stocks, etc. So every time Trump's become president, okay, so last time, okay, it's not every time, it happens the second time, but last time we saw all the financial sector go up, the banks went up, so banks because high yields, so retail, it helps retail, volatility helps hedge funds and all kind of other sectors as well, just because, well, okay, so it's good. Well, I'm not going to talk about options and stuff, but for many reasons, volatility is good. And so this time, yeah, we start seeing it slowly. The trading was good for the banks. The guidance is good. Does it mean it can keep going on? Yeah, most likely it will, I think, for maybe 1 year. And if not, definitely after it will go up. This is what we saw last time, so I don't think there is a reason why his policy didn't change much. I'm just trying check the comments if someone is getting right now or no. No, okay, so everyone agrees. But yeah, I think it will. So I liked BlackRock because okay, so you have many people who talked about the banks like Bank of America, JP Morgan, Goldman Sachs, which one to buy. The answer is always the same, and in the end you see it, they all correlate. We see all of them took 3-4%. Bank of America, as soon as the other one released their good earnings and all, people bought it. Bank of America took plus 3% also, so like it all correlates. I'm not used to doing lives. I'm a bit thirsty now. Well, not a lot, 10 people. So yeah, they correlate, and the momentum might keep going. And apart from that, well, the signals, like the things that we look at, we send and all, like Rio, okay, there is some it's cyclical, so it could take like 25% within the next month. We had the same with Domino's Pizza and which was cyclical, and Lululemon, I think, and it reacted the same way. So I think Rio will take. Yeah, I'm getting a bit tired. So let's see. How long has it been, Noé? I'm not sure. Okay, maybe I'll just leave it here for now. And if you have questions, wait, is there something I missed on the BlackRock options call? Yeah. Okay. So the call was a bit. What I understand is that because the price is expensive, so because the stock price is expensive, you need a bit of money to get in the call because, I mean, stocks you can buy fractions, but with options you don't have that yet. And actually, I wonder why they don't do it. Because they should be able to do it just like they do it for stocks. And I think maybe it's because with stocks is available for retail, but options should not be available for retail because it's risky, Literally, if it went wrong, okay, I bought the 1 month maturity, so the 1 month maturity doesn't get hit, but the guys who did plus 800%, they had 1 week maturity. And if it went wrong, like minus 2%, it would have gone to 0 overnight. So like it's not something. It's okay if you understand that you have to keep it small, but it's not something that anyone should buy because most people they don't understand what they're doing, So so I understand why they do that, why they keep it like this, just to make sure that it's expensive, so like not everyone can get in. And so maybe with Sound it was easier to get in because the stock price was tiny, so you could buy one option for cheap. But maybe one day people will allow fractions as well. I don't know. But yeah, like the idea is always that you should not trade options if you have a small portfolio, just because it's very risky. Like I try not to put like you can't just go all in on one because the odds are not on your side. Like the stock could go up and your option could go down. So like it's always the same idea. Large cap stocks you can go big, small cap stocks go smaller, and options go smaller, crypto, if you trade crypto, go smaller. People recommend you invest 5 or 10% of your portfolio on crypto. It's not like 90%, they will recommend 100% on an ETF and 5% on the crypto. So it's like different kind of risks. And actually, I don't know if we can save this video. It's not a great video, but it's the first live, so for 10 people, maybe I'll try to save it just to see. Anyways, thanks for joining late. Better late than never. And yeah, maybe I can try to set up some 20 minutes live every day, something like this, and very short, so I don't get a headache, because maybe I need to drink water. I feel like I already have a headache right now. And yeah, so like keep it short and maybe try to do it a bit every day. I think the markets are opening soon. We got 20 minutes left, so I will leave it here and speak with you soon. Thanks for watching. I will check the comments, and I will check who was here. I think I recognize some of the names already. SMCI, okay, maybe just this one quick. SMCI, I think, is undervalued. So there was a small video about it. Nothing changed really. It's always the same thing. There is no major news that changed. There are some fears. Okay, so now maybe is a good time to talk about it, because you have the earnings coming soon. But it's always the same idea, like are the financials correct, or were they trying to hide something? Are they going to remain in the Nasdaq, or are they going to be delisted? If they get delisted, maybe some brokers will automatically exercise your shares, so like make sure you got the right broker. And if they do, what happens after? In the past, they got delisted, and there was nothing really wrong, and they came back after. So like, I don't know why they're like so bad at managing their interactions with EY and whoever is reviewing them, auditing them. But yeah, like they got delisted, they came back even stronger. So the idea is that there is a risk clearly on the short term. But if, and it's always the same with risky things. If starts with there is a risk. If it goes right, there is like crazy upside here. Like you're not going to get the same upside on any other stock. We're not going to get the same upside on Nvidia, where everything seems more or less pristine, even if I still believe that it's also a value stock and a growth stock. So there is a growth potential, but it's also a value stock at this level. Like we've seen it at the same price for almost a year now. Last big rally was around the stock split, and it took like plus 180% last year, but it took it only over the first 3 months, Anyways, SMCI. So yeah, SMCI, I don't think we got a lot of stocks that got the same upside, but then it's much riskier as well, and not much is happening now. So let's see what happens. I got a lot of stocks on it. The options, it was profitable in the beginning, then the second play not so profitable because not much happened. The first one, we got lucky maybe. I mean, it's a bit like that, like you play a few times. If it does plus times 6 one time and minus 100 the other time, okay, you're still positive, as long as you don't go all in every time, like you try to stick to the same amount, and you have to keep it small. It's like risky. That's why you say option plays, and not like, it's not an investment. It's more like a play, like a game, But yeah, with proper investments, stocks, cost average, long-term mindset is always best, and the riskier, the more upside. There is no secret, like there is nothing that will give you a free upside and no risk, unless it's like arbitrage, and you have strategies that are like buying futures, selling the stock, and then you check how much you can lend your stock for. Or the opposite, you sell the future, you buy the stock, and then you lend your stock. Well, you have like some strats that can work, but the spread will always be tiny, and it's not something a retail or anyone could do. It's more like something for banks and people with huge balance sheet, and they try to optimize all their cash and things like that. Okay. I don't know how many topics we covered, but markets are opening soon, so let's check the pre-market and see what happens. And yeah, thanks for watching. Okay. Nice. Thank you. Yeah, this is Marina now because everything is cold in Europe, so I can hear, but honestly, it's not very hot here either. I think I'll stay a couple of months and then move again. I like, maybe I'll go to Italy or something. I don't know. Go to London, come to New York. Yeah, well, I will figure out. But yeah, anyways. Okay, speak to you soon. Allez, thank you. I don't ever know how to end this. Okay, should do it here. Thanks a lot for watching. Bye.